Hello and welcome to Vancouver CRE Market Channel. In this channel, I take a data-driven approach to understanding Vancouver's commercial and residential real estate market. My name is Esan and I use AI, data science, and machine learning to uncover market trends, identify strategic opportunities for buyers, and ensure maximum return for sellers. If you are looking to get into the market with a confidence driven by data science and machine learning, feel free to reach me at esan@vancouvercremarket.com or schedule a free 30-minute consultation time using the Calendly link below. All right, so in this episode, we're going to talk about a few economic updates. Also, we're going to talk about the upcoming BOC rate announcement, the tariff, of course, and the effects of tariff on the Canadian or on the Vancouver real estate market. So, lots of material to cover, so let's get into it. All right, so let's first talk about a couple of key performance indicators in the economy, and these are the GDP growth rate for Q4 of 2024 and the inflation rate. Well, the GDP growth rate was very encouraging. The GDP grew 0.64% compared to last quarter, and there is an annualized growth rate calculation that's done, which practically multiplies the last growth rate by number of quarters, which is 4. So the annualized growth rate was 2.6%. That means if the economy were to grow at the same speed as it did in the last quarter, it would grow 2.6% by next year. Now, you might not like this kind of KPI because it is speculative. So compared to the last Q4 of 2023, the economy grew 2.4%, which is what's shown in this graph on the Canada GDP annual growth rate graph. So that's a bit of a good news. The economy grew in Q4. Some people attribute that to the GST tax holiday that we had, and the consumer spending went up significantly higher than what it was in Q4 of 2023. So that indicates that the GST tax holiday had some effect on consumers' spending habit, and they felt a little bit at ease with spending a little bit more money, which helped the economy grow. The other key performance indicator we're going to look at is the inflation rate. As you can see in this chart, the inflation rate has ticked up to 1.9%, which is still below the 2% mark that Bank of Canada is looking for. And as you can see, for the last 6 months, the inflation rate has been under control, and it shows that the economy has stabilized to a certain degree. But the last increase in the inflation rate is a bit concerning. On the one hand, the Bank of Canada wants to bring down the interest rate by another 25 basis point to help bring down the unemployment rate and to keep the good pace of growth. And on the other hand, the bank finds itself in a situation where bringing down the interest rate by another 25 basis point could actually contribute significantly to a rampant inflation rate catalyzed by the 25% tariff rate. So having said all of that, the Bank of Canada might actually find itself under a lot of public pressure to bring down the interest rate to help out with the economy faced with this tariff threat. So this decision might not be, after all, a monetary decision, rather a decision to respond to the public pressure. So we'll have to see what the Bank of Canada will decide. And at this point, I don't have any prediction with regards to the interest rate. I think it's pretty much a coin flip at this point. So let's move on to the next topic.
So let me be clear. We will never be the 51st state. We will bear any burden and pay any price to protect the sovereignty and independence of our country.
President Trump thinks Canada will cave in. We will never, ever bow down to a bully. And at times like these, we need serious leadership and a serious plan. I'm ready to stand up for Canada. Who's with me?
So it looks like the tariff is here this time, unless it changes its mind last minute again. Now, the question is, what is the effect of the tariff on the Canadian economy? To answer that question, we should note that there are actually two different tariffs at play here. One is the US tariff on the Canadian goods, and the second one is the retaliatory Canadian tariff on the US goods coming into Canada. And each tariff has its own set of consequences on the Canadian economy and the Canadian consumers. So recently, the head of Bank of Canada had a speech at Mississauga Board of Trade, and in that, he detailed the effect of tariff on the Canadian economy. I think it's best to hear it from him. He does an excellent job explaining it, and I will try to chime in a little bit. So let me find that video.
The economic consequences of a protracted trade conflict would be severe, but it would be very different, a very different shock than the COVID-19 shock. In the pandemic, we had a steep recession followed by a rapid recovery as the economy reopened. This time, if tariffs are long-lasting and broad-based, there won't be a bounce back. We may eventually regain our current rate of growth, but the level of output will be permanently lower. It's more than a shock. It's a structural change. The first thing we would see is a marked decline in exports. As Canadian goods become more expensive, U.S. demand for those goods would decline. A lower Canadian dollar would provide a partial offset. In our model, with the scenario based on the February 1 executive order, exports fall by about 8.5% in the year after tariffs take effect. That's the green line. Canadian exporters respond by cutting production and laying off workers. With exports to the United States accounting for roughly 1/4 of our national income, the shock will be felt across Canada. Lower export revenues would reduce household income, and retaliatory tariffs would raise the prices of many consumer goods. As a result, consumer spending on everything from cars to entertainment to housing would slow. With export and consumer demand weakening, Canadian businesses would also cut their investment spending, and higher costs and lower profit margins would restrain investment further. With retaliatory tariffs on some goods and a lower Canadian dollar, businesses will face higher import costs. Canadian businesses, and I'm looking at them, buy roughly half of their machinery and equipment from the United States. In addition, profit margins are squeezed because higher costs are gradually passed on to final goods prices in Canada. So what would this all mean for economic growth? Well, in our January projection with no tariffs, we forecast growth of about 1.8% in both 2025 and 2026. But in the tariff scenario, the level of Canadian output falls almost 3% over 2 years. That's the blue line. That implies tariffs would all but wipe out growth in the economy for those 2 years. But if we are faced with a prolonged trade conflict, the only way to offset this negative structural change is with a positive structural change.
All right, so let's break it down. What he's saying is this: the US tariff causes lower demand for Canadian products. The lower the demand, the lower the production. The lower the production, the higher the unemployment rate, and also that means the lower the GDP growth. In fact, he says in about 2 year time, the GDP growth would shrink actually. So negative growth of around 3%. I've heard between 3% to 5% of negative GDP growth. So the Canadian tariff means the import prices will go up. In other words, we are importing inflation. So inflation will go up. And now we're faced with a situation where we have higher unemployment rate and higher inflation rate. There are nuances on this. The tariff would cause a weakened Canadian dollar. When the Canadian dollar is weakened, that means the Canadian dollar amount for every product that the producers sell in the US will go up. In other words, we'll bring in more Canadian dollars for the goods that we sell. However, the catch is we are importing 50% of the parts and materials and equipments from the US to make those products. And by putting 25% tariff on those 50%, the expenses for the Canadian producers and manufacturer will go up. So in other words, the expenses will go up as the revenue will go up in Canadian dollar at the same time. But the problem is we're going to be faced with lower demand. So even though the expenses go up and the revenue go up, but because of the lower demand, at the end of the day, we'll have shrinkage in the profit and the amount of profit that we're going to make because of the lower production level. We're faced with a situation where the US tariff will cause higher unemployment rate and the Canadian tariff will cause higher inflation rate. What can be done? That's the next part of the speech. Let's have a listen.
Now, structural policies are appropriately the responsibility of elected governments and parliaments, not the Bank of Canada. So I will tread lightly here. The bank has previously highlighted Canada's productivity challenge, and it's good to see more focus by federal and provincial governments on structural reforms to increase productivity and investment by strengthening our economic union. Removing rules that restrict interprovincial trade or harmonizing or mutually recognizing provincial regulations could provide some offset to the increased trade friction with the United States. Provinces could also make it easier for workers to move within Canada by mutually recognizing different labor accreditations. There is also scope for all levels of government to reduce the timelines and uncertainty related to regulatory approvals. And better east-west transportation links would make trade within Canada less expensive and help get Canadian products to overseas markets.
So to offset the adverse effects on the Canadian economy, he was saying that we need to do three things. One is the interprovincial barriers, economic projects. And the third one is to have an east-west economy, practically speaking, rather than the north-south economy, now that the south border imposes tariff on us. So these are the three different policies, fiscal policies that can be implemented to offset the effects of tariff. And obviously there are other policies that can be implemented. A few that I can think of is to execute shovel-ready infrastructure projects like we have seen in the past after 2008 crisis and also after the COVID, railway for global market access and interprovincial access, obviously developing ports and such to provide access to other economies. That would be a very productive step to take. And then the capital gain tax needs to be lowered. The capital gain is the tax that people have to pay on the profit they've made on the projects they've invested on. And so it's a tax on investment. And in this situation where we need more economic projects to go on, we need more investors to come in, and for that we need to bring the capital gain tax down a bit to be competitive with the US, so the money does not flow down the states. I've prepared 2 slides here to share with you, and I'll put them both up so you can see. Maybe I even bring myself a little bit, I make myself smaller on the screen so you can see I'm out of the way. So with the scenario 1, so for both scenarios, the initial investment is $1 million, and then assuming 5-year investment term and 15% IRR, which means internal rate of return, that you can think of it as the growth per year for that capital. At the end of the 5-year term, the total amount would be $2 million, which means the profit is $1,011,357, and then for the total, the taxable capital gain in Canada right now is at 50% inclusion rate, so which is $505,679. If you are the top marginal tax bracket, which people who invest that kind of money, they probably are, the total tax liability would be $270,000 in BC. And as you can see, compared to California, we're doing better, but not by that much. But compared to the rest of the provinces or the Alberta and the states, we're not doing well at all. So there's room to bring down the capital gain total liability, to encourage people to invest in Canadian economy. And so that's one scenario for the personal tax. And for the scenario 2, if a corporation invests in another corporation, let's say a VC or some other corporation invests in another startup or another company or a joint venture, and they want to realize the capital gain and pay the taxes, as you can see in the BC, after paying the dividend, if they were to cash out all the money at the end of year 5, according to ChatGPT here, total tax liability for both corporate and personal in BC is $564,000. In Alberta, it's lower, for 95 almost. In California, for 82, and then in Texas and Florida, much lower at 330, and it's a little bit lower in New York at 457. So a majority of the companies, majority of the investment goes through companies, and so you can see that the US is much more competitive in that regard. So another fiscal policy that can be devised is to make sure that the Canadian investors are competitive when they are investing in the Canadian economy. Obviously, you don't want them to get the tax break when they're investing in the U.S. economy. All right, so that's another policy that might be of help. Obviously, there could be other policies like what the governor of Bank of Canada just mentioned, like cutting down the regulations. The problem with the regulations is that they slow down the economy, and they bring down the internal rate of return, or IRR, for the projects. And in some cases, I've seen that they kill projects, especially in the real estate industry, when the timeline becomes too long, the risk becomes unjustified, and then people start to decline investing in the real estate projects that they would have if the timeline was shorter. So bringing down the regulations in order to speed up the total process length is another policy change that should happen. Now, in many jurisdictions, because of the layered system of jurisdictions we have, this would be of a bigger challenge because it's not up to the federal government to speed up some permitting processes. But that applies to all layers of the government. They should all adopt the same sort of policy to cut down the regulations. And what about the effective tariff on the real estate development and construction industry? The 25% tariff on construction material, things like steel, aluminum. Well, what would happen is that the construction costs will go up and the profit comes down. A lot of these projects will no longer be profitable and will be shelved. Lenders will be very nervous and will not proceed with a lot of projects, and builders too will not start building new products. And for those projects that are in the pre-sale process, they're going to see that the remaining buyers in the market unfortunately will vanish, and the project will have to be delayed or shelved. Now, what about the effective tariff on the resale market? This is arguably very different from the construction market because the construction material, the tariff applies to them, and so that increases the cost for the material, and that brings down the profitability of the project. But with the pre-sale, that all depends on the effective tariff on a specific city. So here's a ranking of how the cities will be affected in Canada by the tariff impact. And as you can see, different cities are exposed to US tariff and US export differently. So for example, Victoria, BC is very low in the ranking. That means it's not going to be affected that much. Whereas in Calgary, Calgary is very exposed to the US exports, and the tariff would affect them significantly. And Vancouver also, Quebec, Toronto, and Vancouver, they're not doing too bad. So if the unemployment in these different cities are not affected significantly, then we won't see a surge of new listings into the market. Although we've seen the surge of new listings into the market in the month of January and probably in February. But the tariff won't add an extra load to the market, significant enough for a major price drop. So we'll have to see how each city performs given the tariff, but it's going to be different from city to city, as this chart suggests. Okay, so should I get in the market? Well, it depends. If you're paying a lot of mortgage and one of the income earners in the family is nervous about losing their job, it may be a good idea that if you have the second property, you would sell the second property, or if your mortgage is too much compared to one income earner's income, you might want to think of bringing your house to market and downsize or get something cheaper somewhere else. So it all depends on your personal situation. So if you or your spouse's job is exposed to the tariff, you might want to think of selling the property, lowering the mortgage amount, or selling the second property and keep it manageable. Or even you might have to rent for a while before getting back in the market. On the other hand, if your job is secure, if you're a nurse, if you are a medical doctor, if you're in the service industry and you're not affected by the tariff in any way or shape, then this market is for you because you're going to be able to find reasonably priced real estate at a low interest rate. So you might want to think of getting into the market. But everyone is different. And if you're considering getting into the market, for these reasons or any personal reason and would like to take advantage of power of data science and machine learning to find opportunities in the market or to maximize the investment return, feel free to get in touch with me. You can book a 30-minute free consultation time using the Calendly link below, or shoot me an email at asan@vancouvercremarket.com. Thank you, and I'll see you in the next episode.